Hi, this is Randy Finney with Right Side of the Chart, and this is a post-market session update for Thursday, February 2nd, 2023. Wanted to wait till all the three big ones were out of the way. Apple just reported, so now they're out of the way, and of course Amazon and Alphabet already reported earlier today. All are trading down, but again, that's considering how much they were up today, not a big deal. But I just want to share. I told you I might do an update after the close today, and I'm going to share my thoughts. And that is that I wanted to let these get out of the way. And I always say the dust hasn't even begun to settle. They still have the conference calls coming up. That's going to be big for Apple. Apple missed on just about every metric. First time I think they missed revenues, they said, since 2016. So either way, it's you can't spin it as really bullish. Again, who knows? These guys will get out there and tell you the whisper numbers, this, that. But what I'm getting at is a trading strategy. So I'm comfortable now layering back into some swing shorts. And look, they may pop it in after hours, but it's everything I do, all my trades are based on the RR, the risk reward, and probability factored in. So sometimes I do take lower RR trades, even 2-to-1, sometimes even 1-to-1 if the probability is that high. And again, it all depends on the particular security. Ideally, I like a 3-to-1 RR, but I think right now a short here, we're out of the way now, with stops, again, somewhat is relative to your target. Maybe right above the highs of the day, maybe a little below there. If they run up at them again, they'll probably pop them, maybe up. But I still think we're coming back down to this trend line here. This is the one I was targeting before the close today, but that didn't happen. This is a zone right here, runs from 12,553.65 to about, or called 12,554 down to about 12,500. And there's still a good chance that'll be hit. You have the divergences, and you also have divergences on the 60-minute charts. Let me get to that and show you just a couple other things I haven't showed you, and I'll wrap this video up. So again, nothing big because we're still well above the 200 days in the downtrend lines on most of these, but I'm going to go over a few charts, a couple things I haven't covered lately. Do a quick one here and get it out to you guys. All right. Okay, let me run through the index charts first, then I'll show you a couple other things I'm looking at. QQQ, today, these candles are showing the today's trades in the after-hour trades. We pretty much popped, pretty much today's highs took us right to the top of that most likely bounce target zone, and we still don't have a bearish crossover. We'll watch for that. It would take a little while, but watch for that there. But we are overbought again. I've talked about that quite a bit. This is the first overbought reading in the bear market. And again, I'm going under the assumption, and I'll show you why in this video, that it's still a bear market, despite the fact we're over those first overbought reading. That's the 70-year level or higher since right here. And we all can see what happened there. The time before that, well, you got to go back to the beginning of the bear market, the end of the last bull market right there. All right, so that's that one board, the busy board here. This is what I've been trading all year, using this board right here. I'm not sure what this line, that must be some fibs. Oh yeah, those are Fibonacci retracement levels. Here, I need to brighten them up. Well, I usually have a different board. I didn't even realize I had this one up on this particular board. Let's go purple and see if we can see it. You probably can't see it, but what that is a Fibonacci retracement from the high. There's the all-time high in the NASDAQ 100, QQQ, and the last bull market, pretty much double topped right there down into the recent lows. And I have that line is the 38.2. Remember, I say this often, bear market rallies feel powerful, they feel bullish, and they are, especially if you're on the right side of them. They're fast, they're furious, they're better. They're more profitable to trade than bull market rallies because you have tons of short interest, tons of hopium flowing back in the market, so you tend to have much faster gains in shorter order. A bear market's just like trading a big secular bull market with all the corrections and all that in fast forward. And so I just wanted to point out that this is what I've considered, and many traders, a minimum retracement of a primary trend, that 38.2. There's the 50% fib. up right around the top. Remember, I had this purple box, which is my max bounce target zone. This was the most likely bounce target zone from back here where I figured this rally would end, and that's pretty maximum, where it's not a hard line in the sand, but to me it pretty much is. We go much above there, we're taking out that previous reaction high. Also, you can see here I had it turned down in color, but I've had this line here forever and a day. 312, about 312. I'm going to brighten it up now, and that also comes in exactly with that 38 fib. That was resistance. Why was it resistance? I've had that line here for a while. I see a reaction high there, a major reaction high there. Bear market rally ended there, and so enough and also a reaction there, and so that's what we hit today. So, at this point, now that the big three, now that the Fed is out of the way, the ECB is out of the way, and to me, the most important stocks to the market. Everybody else doesn't really put a dent in the index. I don't care if it's JP Morgan. I don't care if it's, even Meta with their big move. You can see it hardly moved the needle. The NASDAQ 100 was up today, not because of Meta. It popped big last night and hardly moved the indexes because it doesn't carry the weighting that it used to. It's already got knocked down so much. All right, so that's that. And we'll see, and then there's a potential for a lot more. You have an uptrend line here, and again, maybe this is the real deal and there's more to come, but like I said, it's hard to argue that we're not overbought, which we are. And also, you look at the 60-minute chart. I'll go through this quickly. It's a little messy here, but let's look at the market leaders. Apple, just real quick. The white, see after-hour trades kind of all over the place, but what I wanted to point out is if you followed me for a while, you know when I'm trend trading and swing trading primarily, I like to look for divergent lows to go long, and I like to, at the end of a rally, I like to look for divergent highs to indicate that rally may be over. Apple, negative divergence. So if after the conference call today, and more importantly what they do tomorrow into next week, if they can rally up, they'd have to take out my next resistance on the 60 minutes, about 153. They can take that out and take out the divergence. Hey, you know what? It just chips away at the bearish case. Right now, there's a decent case again with that negative divergence, and I drew that uptrend line on the daily. I think you can see it a little bit better. Yeah, there it is. There's the daily uptrend. I'm going to pull that right like that. Comes in nice and clean on the daily, catches the recent lows, catches these candles there. You have a few little wicks intraday moves through there, and again, this is going on the showing after hour trades. So this is what I'll be looking for tomorrow. If that breaks, it would also be, keep in mind, a rejection at the 200s for Apple. Apple, you can go back, look at previous bear markets, even corrections within the great 10, 12 plus year bear market, bull market that we just finished, and you can see that when Apple crosses the 200, it usually starts a correction, and then the 200 days act as resistance from above. So that's a big one. And Apple, of all, we can sit here talk about Apple all day long because it has the biggest impact on the S&P and NASDAQ 100. So it deserves that much attention. So there's that. PPO's, starting to turn down, and we'll watch to see if we get a bearish crossover. Microsoft, let's just look at the 60s. That one took out divergence, so I'm going to give it that. Give credit due where credit's due. Took out the divergences, but it is at. I'll let me pull this old line down right there at that previous reaction high and a gap right there. So it's at resistance. And on the daily chart, that's not the daily. There's the daily. We'll see how the day ends. There's a trend line. This is a busy board here. I call it. There it is. My clean board. Down trend line. So this is kind of a takeaway from where we're at today. Remember, we were at either at downtrend line resistance at 200-day moving averages, which are resistance, or just above. And so where we go from here, and again, it's the breakout is intact. I can say this. You also have definitely even a more objective case to go long here if you're a bull and you believe that's where things are going because you're above the moving averages and the trend lines, and you can put stops below or stops at least, if you're bullish, you get whipped out. I think at best case scenario, I told you this before, we're going to grind around here for a while, and that's going to clear out stops on both long and short. So if you're swing or trend trading and you're short, stops a little above, and if you're bullish, you probably want stops above these uptrend lines on a lot of these market leading stocks and the indexes, and that's it. So Alphabet so far rejected here. Let me turn off the after hour trades and show you that. The regular hours was right about on the just a little bit above the 200s, but below that trend line there. and then I turn on the after-hour trades again, and you can see so far popped up after hours, but then got rejected off there. So, like I said, it's really nothing too much for the Bears right now. These guys, yes, they're down. All three of them are down from where they were today at the close, and especially their regular session. And even on the first two that reported, Alphabet and Amazon, they're well below their post-market highs. They all popped, and then Apple came out and they started fading. Actually, the pop you can see here on Alphabet. Here it is. This is what it looks like after hours. See, they popped up, they faded. That again, don't take too much into this. I'm probably even spending too much time talking about all this. The point, the takeaway here is they're out of the earnings are out of the way. And so there was, the chance of a sudden rip. Maybe Apple says something crazy, on their conference call that sends the stock ripping. I severely doubt it based on what I heard with their earnings. So I'm more comfortable is what I'm trying to tell you, is to stack on some swing shorts here as let's call it a lower than usual probability trade with a higher than usual risk reward if they play out, as far as the index is failing these breakouts and ultimately going on down. And again, you can just draw up trend lines right here. That'll be all these levels right here. This is where that any pullback, quote unquote, should get bought up, but then much below that, and then you can see I have good price resistance, and that's it. All right, so that's it. You miss 100% of the shots never taken. So this is a shot, and it's far from an all-in moment. Just to get a little, go home, put back on a little swing short exposure, and if they pop much above today's highs, then throw it away, let it run for a while, and then look for the next objective entry. I can tell you I won't be reversing and going long with these overbought conditions, proximity to the moving averages, proximity to the trend lines, and divergences on many of the market leading stocks. Let me just show you a couple other things there. And one of them would be the great debate. Are we in a new bull market, or are we in a bear market, a counter trend rally in a bear market? Okay, that's not the chart I was looking at. I've zoomed into this page. I want to talk about the yield curve. This is something I've talked about in the past. Many others have. This isn't any, tricky little secret indicator or anything like that. This is widely watched and followed indicator, and widely considered one of, if not the single most accurate indicator. I always rank indicators on a combination of two factors: their effectiveness, what's their track record, how many whipsaws, and also the simplicity, because there are some with a lot of moving parts. And then there's something so simple as trading above or below a certain moving average, like my 20-month moving average on the indexes, or in this case, the yield curve. And again, this has been around a long time, and it has really an impeccable track record of predicting recessions. And it's simple. This is the 1 and 10-year Treasury bond. So you have the yield of the 10-year Treasury bond and the 1 year, and usually 10-year bonds, you're going to be at a higher rate the longer out you go, because you're locking your money up for a longer period of time. And however, that's normal. A normal yield curve is upward sloping, like this. Longer you go out in time, your short-term 1 year, 3 year, 5 year, 10 year, 30 year, higher. The farther you go out in time, the higher the rate. However, before a recession happens, what we start to see is the bond market, they say, is much smarter than the stock market, or tends to be smarter and can predict. Bond traders can sniff out when the economy is going to turn over in advance, and so those longer term bonds start to reflect diminished economic growth, which also typically equates to lower interest rates. And now you can sit there all day long and say this isn't going to be accurate anymore because all the intervention in the bond markets the Fed did, and maybe that's true. If I thought it was something you could bet the farm on, then that's what I'd be doing, but you can't, unfortunately. But again, it is one of the most accurate indicators. You can't bet the farm on any one indicator. All right, let's just go over it real quick. This goes back into the 70s, and so you can see we inverted here, and you always invert before the recession. It's a great predictive indicator. There's a lot of indicators that some are considered coincident indicators, meaning they go along with everything. Others are, they call them leading indicators such as consumer sentiment, but to me consumer sentiment is really a coincident indicator. The stock market tanks 30-40%, guarantee you consumer sentiment, the surveys go down, the consumer sentiment numbers they pull, because the stock market's down. Stock market rallies 20-30%. NASDAQ's up what, 30-40% for the year, off the lows. Yeah, you're going to see consumer sentiment pop from that usually. And again, it's not really much predictive value, but this is. So there it is. The shaded boxes are recessions. Recession triggered, boom, boom, boom. And it tells you here an inverted yield curve has predicted the past 7 recessions. Even COVID, as quick as it was a recession. It was one that the Fed and Washington refused to allow throughout unprecedented amount of both fiscal and monetary stimulus. It's what I call Ursa interruptus, bear market interrupted by both the Federal Reserve and Washington, but it was yet still considered a recession, and it was accurately predicted in advance before. It had nothing to do. The bond market didn't know COVID was coming. It was priced in, and we got it. And now look where we are. You can see deep down, deep down. So we're in a much deeper inversion than we have been in the past, and yet no recession. So yeah, I think what's coming, and all along I've maintained and continue to do. I think it has a lot of market pundits perplexed, because at this point in time in the other bear markets in the last 40 plus years, we were already down in that meltdown mode and well into the recession. And I predicted and still do maintain this is probably going to be a much slower roll. This is the same thing, but using a 10 and a 2-year spread, and same thing, boom, boom. You can see the recessions in the gray, shaded gray boxes. If you can't, your monitor resolution's not that good, but there's one there, and there's where we are. So boom, boom, boom. Anyway, I just wanted to update that. It's something I've covered in the past, but not recently. And it does kind of go into this. This is where you can say it's confirmation bias, that we popped the 200 days, we popped the downtrend lines, should be bullish. And let's just say I recognize that. I'm not screamingly all in bearish right now, but I suspect because of this and many other reasons, including but not limited to the technicals. You want to go back on the one of the best time frames, a monthly chart, S&P 500. You have the 20-month that I just mentioned. That blue dotted line does a phenomenal job of showing you what the primary trend is. Basically, when you're above it in a bull market, you're above the 20-month. Once you cross below it and lose it, it acts as resistance. It tells you're in a bear market. That was a massive bear market for the NASDAQ. That was the Great Recession right there, 55+% drop in both the S&P and NASDAQ 100. And then this was the Great Bull. And you use it on a monthly closing basis. I always say it. You might say, oh, it broke down there. Nope, that was not a sell signal. That was an intra-month break, only to close right back above it, as we have, and boom. So this is the beginning right here. We closed below it, and we've remained below it, and we're still below it on QQQ despite the rally of 20, what did I call 40, I'm sorry, I meant to say 20% rally year to date. So that's it. Short term, yeah, looks bullish, feels bullish. We caught most of that, me personally, not all of it, but most of it. And now is the we're above it, and so I suspect this. And let me tell you, if it is, boy, that is that rally like this, and that's what happened in 2008, and that's what happened in March of, I'm sorry, in 2000. These bear market rallies were every bit the same. Here, let me show you. And what I was going to say here a second ago was that serves to do what every bear market needs to really get the traction going on the downside, and that is to clear out short interest. So I'm going to just measure the bear market rallies in the 2008, 2007 to 2008 bear market. That first one there in the NASDAQ from low to high was about 24%. Back around the same time here, well, here we had a bottom in November. We even had one in October. I'll just measure them all for you. That was 21%. In November of 2008, we had a bear market rally before the bottom was in, and that was about 27%, right? And I told you the one we just had is about 20%. There's the S&P 500. You can see that one rallied from the November low up until the high in January, about 27%, and then came the next leg down. So that's where we're at. I just wanted to show you the yield curve, go back to where we are today. And so there is some work to be done. Again, it's not, unless you're a very aggressive investor, I don't think it's an all-in moment, but there's enough out there for me with overbought conditions on the daily, negative divergences, and the fact that pierces above the 200-day in bear markets, even though it tends to cap rally. Sometimes it's a perfect shorting op. It was last time we hit it on the NASDAQ 100. That one was in pre-market before, and you can see right there it capped the NASDAQ. And so, this, if it fails, again, that's a breakout. By current accounts and just about all metrics, bullish right now. But based on where we're at in the cycle, I suspect there's a good chance this will fail, and I can say that if it does, very bearish. If the bulls can't hold the 200 on any pullback and the uptrend line and all that, then we're probably going a lot lower. So you don't want to give it a lot of rope, because a breakout's a breakout. Somebody asked me about the semis today in one of the updates. Said, look, nothing but bullish price action recently. Like everything, it's at key fibs. But here's my board of the SOX right here. Philex SOX Semiconductor Index ETF. There's your downtrend line, breakout, back test. See, it came a little bit below the trend line, but then rallied. But we're right at resistance. This chart might seem busy. Let me see if I have a clean board. No, I'm just going to show you why that's resistance right there. You had this topping pattern. That was really the support right here. It was a breakout. There was all-time highs. Semis were bouncing around. Put in this head and shoulders type pattern right here. Left shoulder, head, right shoulder. Broke down below it, and played out for a big drop. And now that was support. A neckline is support on the head and shoulders pattern. Support, once broken, becomes resistance. This is the first time we've tested that level since here. So yeah, check mark for the bulls, taking that out. Check mark for the bulls, taking out the downtrend line. I'll give them all that, and then some. And if they can build on this, then you know what, that's going to be bullish. Won't change the fact that I think we're still going lower in the coming months to even possibly years. But it may change the near-term outlook for the market. But as of now, like I said, RR is pretty good for shorting, especially now that the fangs are out of the way and you don't have to worry about that. 60-minute, like me, these divergences here. Always like some divergences on the 60-minute to make a case to short. I'll have to look at the individual semis. They probably have quite. Look, if the big tech is going to big tech, and you mean that those market-leading FANG stocks, Apple, Amazon, Meta, Alphabet, if they're all going to fall, the semis will most likely fall even harder based on how much they've run up. There was the last divergent high right here on this 60-minute chart, and you can see that drop there. There was a divergent high, there was a drop. So, and there's that, you can see the resistance. I already had it here. That was an old line right there, an old final target that I had from back here. Must have been bullish and long. Yep, I can see them here. T1 was hit, T2 was hit, T3 was hit, and then before we reversed, I eliminated that target, looks like on August 8th, right here in the beginning, and said that's it, booking full profits, and then turned around and made the case to short it. And T1, T2, and those were hit. So, but it was a target back then because it was resistance. It just, I always say the charts are dynamic. I'll change my trading plan as they develop, and that's what happened there. We started to diverge, and that and other things at the time must have told me to close out the long and get short. And so now, point is, that was resistance back then, and it still is now. So there's a reason, if you want, definitely take a shot at the semis. Like I said, they'll most likely fall more than the broad market, if I am correct. Nvidia at resistance 209. I didn't plan to go through the semis, but you want. I always say the semis are like the canary in the coal mine for the tech sector. They usually first to turn, and both on the bottom and the upside, and they kind of give you an insight. When chip sales, or the chip industry as a whole, starts to slow, it's because it's an omen in the tech sector, a bad omen. And likewise, when the tech's in a bear market or correction mode and the semis start to perk up first, hey, it shows you big tech's ordering semiconductor chips. And so Again, it'll help you get ahead. So either way, there's a trend line if you don't want to. Well, I like to, in this case, short resistance and then maybe add on the break of the trend line. They were at 209 big. That's that same resistance I showed you on socks. I'm just kind of going through these now since there's, oh yeah, nice level there. Taiwan semi reaction high here, support, boom, hit that. PPO bearish crossover, divergence right there as well. What not to like about that? So time to start getting short the semis. ASML breakdown recently, back testing, big negative divergence. I'm just going through the holdings of SOXX, guys, if you didn't figure that one out yet. AVGO Broadcom, set an alert here. When that trend line goes, that's a short on Broadcom. It's also at resistance right now with negative divergence. My confidence is high enough to start shorting these, and I'll probably start doing that tomorrow. Individual semis, Texas Instruments, well, looking better than most, but a lot of resistance around here. I won't short that one. Qualcomm broke out of the trend line. There's the story, and it's just like the stock market. Either these breakouts are the real deal, and at the very least, I think they're good for a pullback trade to test those levels and then do this. That's my most bullish case right now. What I think is the most likely, and then my second most bullish case would just be some consolidation here for a while, work off the overbought conditions. And the most bearish case, which I'm leaning towards still, is that this whole thing was just a false breakout and cleared out a lot of short interest, sucked in a lot of longs, and we're going to take another leg down relatively soon in this bear market that's clearly underway. Turn off all the lines, lower lows so far in Qualcomm, and lower highs. We just need to go down and take out these lows, and it will be, kind of bigger picture. You look at a stock that just finished a bull market run and all the way here and has been working its way lower. All right, let me wrap it up here, get the video out to you guys, and obviously you'll hear from me tomorrow. We'll see how, and I'll be very eager to see how the market opens and trades tomorrow during the regular session. Betting on a down day and betting on a down week next week. But we'll see. If I'm wrong, then guess what? I stop out with these index shorts, and I don't have enough to hurt me. But if I'm right, I'm gonna may continue to layer in. I'm gonna play that one as it develops, and I'll let you know my thoughts tomorrow. This has been Randy Finney with Right Side of the Chart. Have a great